You are watching Notepad. I'm your host, Ibrahim Sani. Very recently, we've had StashAway, the Robo-Advisor, on the show talking about the growth strategy for themselves, as well as during the launch of the cash money market business, whether or not there's going to be any take-up in this sense. So joining me today is StashAway Country Manager, the StashAway Malaysia Country Manager, Wong here to give us some updates on the company itself. And of course, StashAway today have announced that they have more than 1 billion US dollars asset under management. That's about 4 billion ringgit assets under management. And this is, of course, the first time a robo-advisor of their sort is hitting that kind of numbers. So Ken, thanks for taking the time to speak with us. Let's go through step by step in terms of the recent events that has happened in StashAway. We'll begin with the announcement, the $1 billion asset under management. Is it spread across all the countries that you guys are operating on, in a particular country?
Hi, Ibrahim. Thanks to be here with you to share this significant milestone. Yes, indeed, this 1 billion US dollars is comprehensive of all the markets that we operate in. So that's Singapore, Malaysia, and also very recently Dubai. So, this is a very, very significant milestone for any asset manager to get to. 1 billion US is, puts you on the map for sure. So I would say that for the markets that we operate in, we are definitely already in the realm of the mainstream.
Yeah, and this is the point, right? Because it took you guys 4 years to get here, and by any means and measure, it's actually quite fast for you to get here. Does this mean that the market is actually quite, I guess, familiar with the kind of services that you guys provide? Also, what does this mean in terms of the kind of interest for consumers or investors in this sense in trying to adopt for the traditional type of investments?
Yeah, exactly. So it took us just a shade under 4 years, 3.5 years to be exact. So, and to count on retail investors' money as well. This adds more significance to this, which speaks about the traditional way that wealth management is managed. Right, it's inefficient, it's expensive, and the markets that we're operating in were hungry for a solution that was digital and affordable and a way for people to access global investments. So I think what is key here is that we got not just product market acceptance, it's all good to have a user-friendly app and quick registration and a seamless experience. But the real key here is our performance has been good. As you know, any investment product needs to return good performance as well as commensurate with the risk that they took. So since our launch, our portfolios have done anywhere between 3.5% to 17% returns per annum. This is annualized since 2017. So 3 to 17%, according to different risk levels, is very, very commendable, I would say, considering the rough years and volatile years we've been in.
Do you think that hitting the first billion is easier than hitting the first 100 million in terms of your AUM growth?
Sure, we actually accelerated as a fintech company and as a startup company. We have grown increasingly quickly. So the first 100 million was actually, it took us 15 months, just over a year. And it took us, only 2.5 years after that to reach 1B or 10x from there, right? And that speaks to the rapid acceptance of this product, and also it speaks to the effectiveness of our growth strategy. And at the core of it, the returns really speak for themselves. So I think all considered, all those factors really, really got us to this huge milestone.
Because of the momentum that you guys are on, do you think that hitting the next 100 billion is going to be easier then compared to hitting the first 1 billion?
Well, 100 billion is a very, very lofty goal, Ibrahim, but I think, the markets that we operate in, Singapore, Malaysia, Thailand in Southeast Asia, and then Hong Kong and Dubai in different wealth markets in Asia and MENA, are huge addressable markets for us. So when we did our market sizing, it looked like this there's 4 trillion US dollars in wealth in these 5 countries combined. In Singapore, there's almost 1 trillion US. In Malaysia, there's around 200 to 300 billion US. So it's a very big market, and I think to reach that milestone, it will take some time, and the country expansion will take some time. But we're confident that we're here for the long haul.
Does this also mean that you guys are going to be introducing interesting products, things like margin financing with low interest rates, trying to get more investors in? Do you think that this is possible?
In the next year, I think what's important for us is to launch in a few countries that we are just starting in, namely Thailand and Hong Kong, and then to consolidate our leadership position in Malaysia, Singapore, and Dubai. In terms of new products, specifically margin that you mentioned, I won't rule it out, but I would say that there are a few more product categories to really introduce and think about before getting to margin. Margin is a completely different line of business and completely different licensing as well. So we want to be a little bit more cautious when it comes to borrowing to invest. We always are proponents of investing your spare cash and things like that. But there are ways that we can definitely accelerate our growth. Happy to talk about that as well.
Yeah, let's talk a little bit more about some of the products that you guys have launched. The money market product, is it performing? Is there a take-up? What's the interest like?
It's been great. We launched it in July in Malaysia, as you know, and we launched it at a rate of 2.4% per annum, which is great considering the modest risk you're actually taking on. And since then, it makes up a significant part of our local Malaysia AUM, and that speaks to obviously how much cash people actually have in their wealth. It shows that in Malaysia, there's actually people have around 60% of their cash, 60% of their wealth in cash, and that is really too much cash if you ask me. 700, 800 billion ringgit in cash on the sidelines, which is not enough if you really want to build wealth. So we've seen a significant uptake here, and more so with interest rates at historical lows, 1.75. I think something that gives you a rate higher than that and doesn't impose any lockups really speaks for itself. So it's a big part of our local AUM. Yes.
Fantastic. Okay, we'll go for a short break. When we come back, we'll talk more about some of the inside baseball, I would call it, of StashAway that's coming up after these messages. Welcome back. I am Ibrahim. Joining me is Wong, the country manager for StashAway. They've just hit $1 billion US in terms of AUM. We're here having him talking about the workings within the company. Ken, let's talk a little bit more about the past 4 years, the trends that you've seen in Malaysia as well as in the rest of the countries that you guys operate in. Now, we understand that StashAway is, of course, a privately held company, and there are periodical reports that you send to regulators, including that to the SC. But as a consumer, we want to understand a little bit more about the trends and behaviors of investors going into the platform, particularly investors in Malaysia. First off, let's understand a little bit more about the split between retail investors and non-retail investors. What's it like?
Right. So retail investors make up the vast majority of our AUM. We are a B2C, retail-facing platform first and foremost, which is why you see it's really easy for you to download and go on the website and get started. We're not really in a position where we are looking to attract corporate and institutional money yet. So I would say like well over 95% of our assets under management come from retail, which speaks to, again, the 1 billion milestone, because it's been an underserved market for a very long time.
And then when they choose a particular risk profile, what's the appetite like?
Right. So when you sign up, we actually have you answer a few questions, and we make a recommendation about what portfolio you can choose for yourself. But you can also choose more conservative or more aggressive portfolios. We have 12 to choose from, but the more popular ones that we see are actually the more balanced portfolios, anywhere between 35 to 50% equities, which is a good place to start because those portfolios have good risk-return ratios, and people really should be invested in balanced portfolios if they are in their 30s and 40s planning for their retirement.
But can you share the split between your customers choosing one particular type of portfolio over the other? Is it possible that you share?
Yeah, they can actually set up one portfolio or multiple portfolios, right? So we are seeing that most of them actually choose around 35 to 50% equities in their portfolio.
All right. Do you know why? Why are they choosing the high risk portfolio over a more stable one?
I would say that it's actually balanced. It's not high risk. High risk is around 90 to 100% equity. So 35 to 50 is actually very, very balanced. And I think the reason for that is because people have medium medium-term needs. You know, the people who are signing up to our platforms are people in their mid-30s. So they're saving for their kids' education, also signing up for their retirement. So a balanced portfolio is a good way to begin. And then after that, I think people will discover their own risk preference. Then they can always change their portfolio or set up a new portfolio.
And then, of course, when we talk about the monthly deduction or contribution towards their investment portfolio versus, I don't know what you call it, a staggered kind of drop-off for their investment portfolio, what's the split like? And what's your recommendation?
Right. So our recommendation is for people to dollar cost average because, as you may know, as an experienced person in the market, timing the market is very, very difficult. So we encourage dollar cost averaging, and at least 40% of our Malaysian customers actually do recurring and regular deposits. And that's a very good thing because they're not essentially trying to time the market at the very bottom, which is very, very, very hard to do. So with this recurring deposits, we also see it as a very good sign because it means that people are choosing StashAway as their core investment platform to put their salary in every month.
Let's talk a little bit more about ETFs per se versus going straight into the stock market. There is a host of arguments in terms of which one would be a better suited kind of strategy. Julian Ng, my ex-colleague, and myself are ETF people. We don't normally like hitting the market per se in terms of single stocks. And it seems that kind of aggregated approach is beneficial when it comes to high volatility market scenario like right now when we have a pandemic, a sustained pandemic, a pandemic that won't go away. Because of this, do you feel that the future is bright for ETFs? And of course, okay, I'll ask the follow-up question later, but do you think it's bright for ETF right now?
Yeah, I think it's been bright for a very long time. It's just that it's taken a while to come to our shores because our market is still an emerging market. It's mainly about having more choices of ETFs to give you exposure. And it's also about distribution and marketing, right? So while there are some ETFs in Malaysia, it's still very undersized and it has a long way to go because fund houses tend to push more expensive and therefore more profitable to them unit trusts and structured products. So I think that us coming into the market, bundling ETFs into portfolios or funds shows that the popularity of ETFs is slowly becoming mainstream. Just case in point, last year, Ant Financial Alibaba was all the rage, and as they approached their IPO, but then obviously the Chinese government clamped down, and the Alibaba stock itself took a bit of a beating. But if you just bought a Chinese ETF with Chinese exposure or internet sector exposure to the Chinese market, which we have, you will see that the effect on the overall market or sector is much more muted. And if you went all into Alibaba, you would have lost your pants, right? So it's really to your point about diversifying, and then clubbing a few ETFs together to really be more diversified across different sectors and different asset classes.
Of course, what we're looking at is managing that alpha beta risk profile. Yeah, let's talk a little bit more about the follow-up question that I want to have, because right now during the pandemic there are up and coming companies that wouldn't necessarily have performed if there wouldn't be a pandemic. And because of the popularity of ETFs, you are taking some money from the investor pool into this kind of aggregated result or aggregated portfolio, depriving these kind of companies from possible investments. Do you think that this kind of argument holds water? Do you feel that you are indeed depriving the market in terms of the smaller players, the money that would have been invested by these investors?
Right. So the truth of the matter is that the ETF market in the US, where we select our ETFs, is actually very developed, and there's over 5,000 ETFs listed there of all different shapes and sizes, right? So there's many different cuts of categories: large cap, mid cap, small cap, and then across different sectors as well, across different geographies, across different asset classes. So if the argument is that it deprives or doesn't give enough attention to small caps, I would say that there are ETFs that already cater to those things, and the market is huge, right? The market is massive. So active fund managers or stock pickers, like the likes of your Robinhoods and all that, will still have a chance to pick out these things. There's no one silver bullet in this personal finance and investing world. There's always different ways to get access. But if it comes to mainstream core holdings, I think ETFs are the way to go forward for people who are more keen to pick stocks and to trade, daily. I think they can still uncover those gems and those small caps that you mentioned. So I think it does tell you first and foremost that the fund management industry is really, really expensive, and that's why retail investors and institutional investors are preferring ETFs these days. But at the same time, the market is big, so there's still allocation to actively manage funds, and the individual investor can still go out into the market and look for these small caps and maybe undervalued stocks.
It's interesting that you mentioned Robinhood, because Robinhood is in the news right now, being accused by various state and federal authorities in the US for gamification on their platform, for acting not in the best interest of their customers. And of course, this is just a tug of war between the entrepreneurs, i.e. Robinhood, versus the regulators. Do you feel that such a thing is happening right now, or could have happened right now in this part of the world, in Asia, in Malaysia?
I think that's a good point, because what they provide is brokerage-free trading. And if you're not paying a fee, you are the product, right? So the same way you access Facebook and Google and don't pay anything, your data is the product. So your order flow is being tracked by these no-cost brokerage players and being sold to institutional players like hedge funds, which means that you should be well aware of the risks you're taking, data and investments-wise, so that you make informed decisions, right? You should go in with your eyes open. I think in Malaysia, there's, as so far as to the regulated space, that's not an issue at all. Our brokers and our fund managers all are regulated by SC, and there's no such impropriety. But I do think there are Malaysians that invest abroad and use investment platforms that are not regulated by the SC or Bank Negara. So I think they should be even more cautious when doing so, because if anything goes wrong, you have no recourse. So it's always best to invest with a licensed Malaysian player.
Yeah, like you guys. Hey, let's talk a little bit more about regulatory requirements. Do you feel that Malaysia, particularly, right, being the country manager here, do you feel that our laws are, or our, I guess, guidelines are up to date in terms of how we can push forward this industry? Because I am an aggressive investor when it comes to wealth management using your kind of platforms, and I diversify not just with you guys but also all the others within your class. And I feel that there might be something missing in terms of us trying to be up to date with the rest of the markets, particularly that of Singapore. Do you feel that we need to, rethink about how we approach the market right now?
Yeah, I think it's a very Malaysian practice to look abroad and go, wouldn't it be nice if we had this, right? I think the more progressive of us always feel that way. But I also take the approach that you need to keep in line with the speed of your market. And it's not just about whatever overseas countries have, but whatever fits our market right now. So I think the regulations that we have to govern fund management is actually very progressive. And to have a framework to govern digital players like myself, like StashAway, is already very progressive to begin with, because the agenda was to make investing more accessible to the general public, and they've definitely achieved that agenda item so far, the SC. So I think in terms of getting us off the ground, the SC has been very progressive. We would like to see, as the industry becomes more mature, that digital players like us also get access to certain retirement schemes, like your EPF, Members Investment Scheme, or your PRS scheme. So we think that because we already manage a significant amount of wealth and probably meet the criteria of a safe fund manager, we would also like to be open to schemes like this. And I think that's what the regulators are trying to do. It's just a matter of time, I think. So if you ask me, what would we like to see? I think we would like to see more access to those retirement schemes.
Having said that, having access to retirement schemes is a way for these retirement schemes to diversify their portfolio as well. We all know that they are busying themselves trying to find investments overseas, and it's not that easy trying to find investments overseas. The rate of growth for EPF is actually quite huge. Every month, they're incoming billions because of tax income deductions from all the salaried employees here in Malaysia. Do you feel that there is an incentive for them to talk to the regulators to get it done?
I think so. I think it's about balancing the needs of the contributors and also their mandate, which is increasingly hard to do when your fund is very big, right? So as you approach 1 trillion ringgit, and it's been managed very well, I think they need to think of ways to either diversify the investment base, to essentially privatize some of it as well, and to get access to overseas markets are very good things to do. So for example, in more liberal markets like Australia, the pension schemes there are very, very liberal, in the sense that individuals can actually manage their own retirement funds. We can here too, to a certain extent, but I think what we see in those models really show that once you reach a certain level of investor education, they can take their own pension schemes into their own hands and diversify their investments a little bit more. So I think slowly we are seeing that, and we like to think that we're part of the overall long-term solution for the Malaysian retirees too.
Final question on this. Where is StashAway going next in terms of markets? Do you plan to enter new countries in terms of access to non-digital customers, people who might not have handphones, for instance? Do you think that those would be a good, target market to reach? What's next for you guys after hitting 1 billion AUM?
Yeah, so country expansion is definitely on the mind. In November, we launched Dubai. That's been up and running for a couple months now. Very, very good initial traction. We have also made inroads to Thailand and Hong Kong. So those should be up and running within the year. Obviously, before that, there's a lot of licensing groundwork that needs to be taken care of. In the existing markets that we operate now, we want to consolidate and grow. That means, doing the good work of educating people, exposing people to the platform, and slowly growing their balance. Returning good performance is something that shouldn't be taken for granted either. The performance that we've been putting out for the last 3.5 years has been good, but we want to make sure that we continue that trend. When you mention offline customers and maybe more rural customers, actually our focus is still very much on the urban, digital savvy customer, and that's mainly because of our business model, right? Our management fees only account for 0.8% per annum, and there's no sales charge to go along with it. So we really need scale, right? And to get scale, we need to market things in a digital way and acquire customers in a very, very rapid way. So we don't really want to rely on, physical roadshows and things like that. We want to rely on, very, very efficient digital marketing to do that. So while we do want to democratize the platform as much as possible, when it comes to where we focus our attention, it really is online rather than offline.
Fantastic. Thanks, Ken. That was Wong Ken, the country manager for StashAway Malaysia. If you've missed any part of this interview, just head on to Astro AWANI, look for Notepad. Plenty of interviews like this can be found there. Until then, thanks very much for watching and goodbye.